What's up, you guys? Zoe here from oneglancetrader.com, and in this video, I truly believe that I will be able to save you hundreds, if not thousands of dollars with the content outlined inside this video, because you've either clicked on this video because you're either interested in selling options or interested in the wheel strategy, or you have been selling options or doing the wheel strategy and you are assigned or own a minimum of 100 shares of a particular stock and it has not yet recovered. And I tell you this for a fact, especially in these type of market conditions, this will happen to you. So if you've been really lucky and selling puts 30% below the current price, picking up pennies in terms of premiums, um, eventually you will be assigned. And I'm going to be using ChargePoint as an example throughout this video of things that I've done wrong or things or mistakes that I've made, which, if I just did these couple of little steps, I would have either been at a better cost basis or B, not even been into ChargePoint inside the first place. So we'll be using that as an example. So I'm speaking from experience here, and these are big numbers that I'll be showing you guys. So, if you are, especially if you're new to selling options or looking at the wheel strategy, watch this video right to the end, because the tips and tricks, the lessons that I'll be going through is going to be absolutely amazing. So hope you like this video. Make sure you smash that like button and comment down below on stocks that you are currently underwater in, or stocks you're considering selling options for, and put it through this kind of screener that I'll go through to hopefully make you think twice. So like I said, I firstly want to kick off with the example of ChargePoint. So back in July 2021, I started selling puts to do the wheel strategy, and I didn't mind being owned ChargePoint shares, and I didn't expect, to be assigned at $35, and fast forward to nearly just under a year, that we are down 61% from that initial um, uh, shares that I got assigned to at $13.48. Fortunately, with some of the things I'll be showing in this video, my cost basis is below 35, but it's nowhere near 13.48. So I'll be going through what's happened over time and then outlining what, in my opinion, what you guys should be looking at if you guys are interested in selling put options. And look, I'm gonna state this: selling options and the wheel strategy, you can make very decent money. I've shown on my YouTube channel how much money I made in the 2020-2021 tax year, and things that I've done as part of that. So again, you can make decent amount of money doing this, but again, there are risks as well with any type of investing slash trading. So what we're going to be going through, I've tried to put these into a step format so it's easy to digest this type of content. So we're going to go into three types of phases here. We're going to be looking at what to do and the checkpoints to look at before placing a trade. So before you place any put option, what are the things that you need to look at and what are the things you need to consider. And it's this step, in my opinion, is the most important step, right? Managing and post-trade assignment, again, you're kind of in the trade now, or you've been assigned the shares. There are steps that you can go through, but the aim is not to get to that point, is to proactively avoid being in stocks or selling put options and stocks before kind of assignment, or before hitting the kind of sell button. So the first thing, and the biggest mistake that I made with the ChargePoint stock, is not doing any real fundamental analysis about ChargePoint. And again, this video isn't about looking at ratios and all these kind of different things. This video is about, 3, 4, 5 little checkpoints, which again will save you so much time, so much money, and avoid stocks that, especially if you're starting out, probably that you should not really be involved in. So some really basic ones. And again, I've benchmarked it to something like PayPal, which I'm actively now selling puts on, and you'll see why of how I shifted my mindset in 2021 to 2022. So the first thing is, do you understand what the company does? Yes, I understand what ChargePoint do. They are charging stations for EVs. They also have a services division of where you can pay X amount a month for them to provide energy and also for the hardware as well. So they are hardware and services business. It's their services business that I'm the most interested in because it's reoccurring revenue, high margin type business, and not going to go into ChargePoint in a lot of detail inside this video, but yeah, they are the market leaders with the highest market share of EV charging stations in the US. So, fairly recognizable company. PayPal, I'm not going to go into that. Everyone knows what PayPal is. So, do you understand what the company does? It's not some biotech stock that, you don't, and you're waiting for some FDA approval and you don't have a real clue on what is going on. So, those are stocks that we want to kind of avoid. The next piece is, what is their top line growth? Is it growing over the last 5 years? Now, ChargePoint hasn't even been a public company for 5 years, and that was my first red flag, right? And as you can see with all of these, right, it is growing its sales volume for the data we do have, but it's not got it for the past 5 years. Net income growth, they they're not even profitable today, which is the third point. They are a loss-making business because they are growing. They are a growth company, and if you look at a life cycle of a growth company, profitability in the early stages is not really there. So what I have learned over the past year, even though you get higher premiums for selling options on companies that are in the growth stage or classified as growth stocks, they are the more volatile stocks, right? Well, you say that PayPal's all check marks, and PayPal's probably lost about 60% over the last year as well, but we'll go on to that inside a second. But ultimately, if you have these four criteria, or especially the last three, of sales growth of the past 5 years, net income growth of the past 5 years, and is the company currently profitable, that will then take you out of most growth stocks. Not to say that when ChargePoint does become profitable, you can't start selling put options on ChargePoint when those three check marks come in. I do believe those three check marks would come in, but at this stage, it's not really the right place for me to be at the moment to park my money in terms of this. So, again, I would have some sort of fundamental criteria. It doesn't need to be these three. What I personally do, I've got a lot more of these. If you're interested in a video of understanding all the points, then I put that in the description or in the comments down below, and I can create a video on that. And you can see PayPal hits all of these criteria. The next thing is once you've got a stock that has hit those criterias, is what is the strike price that you want to be selling puts at to get premium. And one of the biggest things that I've learned over the last 6-7 months is understanding the concept of finding the intrinsic or fair value price of a company or a stock. What the intrinsic value basically means is what is the asset value or the fair value to pay for that company. So if I was to go buy a business from yourself, let's say you have an Amazon FBA business, right, and you say to me, Zerb, I'm willing to buy this I'm willing to sell this for you for, I don't know, $100,000, for example. I will be asking so many questions to understand, is that a fair price to pay, or is that over, or is that under, based on my calculation? And you should be asking that same question with the stock. Now, there's many different intrinsic valuation models out there, and one of the ones that I like to use is the earnings valuation model. And what I've done is I've created a free indicator called the OGT intrinsic value indicator. And I have created a separate video on this. I think it's the last video that I've done that goes into the detail of of this particular indicator. So I'm not going to go into the settings and stuff. I'll link to it down below, top right hand corner. You'll find it somewhere if you want to understand more. But my view is that you watch that video, and before you sell a single put option, you go and work out, or at least get an estimate through analyst estimates of what the fair value price is for this stock using this model. And so using this model, you can see here that, look at this, like PayPal has had highs of, about $300, and it's currently trading at, $92. This is a profitable company, as an earnings per share $3.51, right? And look at that, it has dropped dramatically. But if you look at where the fair value is for PayPal, right? It's down here at a high assumption, if you assume they're going to get an EPS growth of, 18%, is around the $79 mark. So even as it dropped, you might be thinking, oh, PayPal's dropped from 300 to 200. That's cheap, right? But the fair value of it is not even there at its fair value, right? So this to me starts to become quite interesting over here. And again, watch the video to understand where these numbers, how this table calculates, but the indicator does it all for you. You just have to put in some assumptions, and I tell you how to find those assumptions in those videos, because you have to predict on what the earnings are going to be for PayPal over the next 5 years. And once you've calculated all of that or added those numbers in, it plots it on a graph on the chart to kind of show you. And again, it plots it all out um, over the next 5 years. So at today's price, at 92, you're paying around what it should be valued in the fair value in year 3, right? So in 3 years time, according to this high assumption model. So you can see here it's at 92, and the high assumption, if you assume 18% earnings growth over the next 5 years, is around $79. If you assume 15% earnings growth is around 63, and 12% earnings growth, it's around 45. So it's starting to become attractive to value investors. And what my suggestion is it's at this time you start selling puts below the intrinsic value. And what this does from a psychological perspective is that if you did get assigned the option, you have a stock that you obviously, I'm assuming that you like, you understand what the company does, it's growing its sales, it's growing its revenue, it's growing its profitability year in, year out, and it is below the current market value. And, the reasons why most of these stocks are falling, right, is inflation, Ukraine, Russia, war, all these macro events, but the underlying fundamentals of the company, i.e., PayPal, has not changed, right? It's still growing, it's still smashing. Just recently did its last quarter earnings this week. Again, estimates beat. It's up. It's up 11%. From there. So, my put option is probably doing very well at the moment. And again, if it does continue to go up and I miss the boat on not owning 100 shares of PayPal, I'm not too fast. I'll walk away with my premium. Thank you very much. Move on to the next stock, and I'll wait for it to come back down. You do need patience to go find the right stock to do this strategy, but the market has moved so much. There are a number of stocks, and again, if you want me to do a video on that, comment down below to go through kind of the stocks that are nearing its kind of fair value or are fair valued. So hopefully that kind of makes sense in terms of we know what the company does. It's growing. It's growing. We found the intrinsic value, and the last piece is to decide how much you want to invest or trade into this particular stock. So, and one of the biggest things, the biggest mistake I made, which is why I'm in the position that I'm in, is that I didn't split the investment into even trades. Now, this is my investment here, which I'll talk through in a second. You can probably work out how different this model is to how this model is. So let's just say I have 22.5 grand that I'm willing to trade / invest into PayPal. So we know that the current price is 92, the high assumption intrinsic value is 79. Let's say that you're willing to trade one contract or 100 shares at the $75 mark for 7.5 grand. Let's assume that you get assigned those shares. Then you take the next one, you then decide what these numbers are going to be, these strike prices, so you spread them out slightly, so you're playing worst case scenario, is $60, 100 shares, $6,000. Then you do the next one at 50, you do the next one at 40. So therefore you'll have a total of 400 shares at 22.5 grand at a cost basis of 56.25, right? So even if the share price does drop to 40, you haven't got 100 shares. You're not sitting at the $75 strike. You're sitting at the $56 strike. So you're breaking your way down. And if it gets to this value, assuming that the fundamentals of the company have not been changed throughout this time, then you need to reassess. And it's down to macro environment changes, and they're still growing, then you know we'll talk about that in the post slide, but you've allocated your full amount at the best possible price that so you're forecasting this outcome, which may or may not happen, but at least you're forecasting it and prepared for it before you've even pressed the sell button. That's the most important bit. And if we look at my charge point example, you will see here that I'm very top heavy, right? And this is why I highlighted as even trades. I've got 20, it's about like probably best part of like 50,000 sitting at strikes at 35, 31, and 27, right? And therefore, I did 1,000 shares at 27 because I didn't expect it to keep going down, right? But now I've experienced this, I know that if I've got, and I didn't ever want to put 73,000 in this, I've just had to, money I've put in, premiums I've collected, I've reinvested back into ChargePoint to bring down that kind of cost basis. So I'm sitting here at 2,700 shares at a cost basis of 27.17, which is a lot lower than the 35 that I had originally that I showed you in the first slide. But ChargePoint is trading at what, 13 and a half dollars. I'm still way behind where I need to be, and in that time I have collected $11,000 in premium, which is a 16% return on the 73, which is pretty good. I'm not gonna complain on that, but I rather have 0% and have my 73 grand back, right? So please, 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 when you place trades and you are looking to cost average in, work out where you want to be over here. But my point again is I wouldn't be in this scenario if I did this bit. I wouldn't even be in ChargePoint. I'll rather have 75 grand in PayPal, but below its fair value. So going back to here is I wouldn't have even invested throughout all of this particular here. The premiums would have been really nice over here, but I wouldn't be in any of these types of scenario. So again, what we're trying to do is minimize our risk and invest in or trade top quality companies. So a lot of the time I spend in this video is on before placing the trade. So please look at this stuff. Any questions, comment down below. So we've done all of that work and we are happy to go into our first put option, 100 shares, one contract into PayPal. So again, I'm shooting this video on the 29th, 30th, so I've gone about a month out. You can do weeklies, 2 weeks, whatever. I'm not here to talk about option expiry dates, but I've just gone with a monthly option. Again, the current price is 92.09. So we want to sell the $75 strike, and we would pick up $1.21 per share, which is $121 in premium, which is 1.6% return on our investment for just under 30 days of effort or work, right? Which is absolutely great. You make 1.6% every single month for 12 months. Good return, especially if you've got other things inside your portfolio as well. Now, let's now base an assumption for a second that PayPal drops to $69 1 week before expiration. Oh no. Oh no. This sounds like This sounds like this scenario all over again, right? So what do we do if that happens, right? Firstly, because you've done all that work beforehand, you shouldn't panic, right? Because you have a plan that if this does happen, you then start selling whatever it was. You start selling the 60, the 50, and the 40, right? You've got your plan of action in place there. And again, you've only risking 7.5 of your 22k investment so far into this particular stock, right? So don't panic. Option one is buy back the put option for a loss, which in my view, if you've done all the steps before, right, that shouldn't even be a factor, right? You'd rather take assignment than doing that, because you're buying a stock below its intrinsic value based on your assumptions and your calculations, and therefore holding it over the long term. It should go back to its fair value price over time. How long that will take, I don't know. But you also got to look at as well, PayPal has dropped a lot since you started to start owning the stock. We are now, I think this is this is the COVID. Look at the COVID drop. Looks like a little thing. The low of COVID was 82.07, right? And you're selling, it has to go below the pre-pandemic drop, which is absolutely insane, right? Just shows how much, overinflated price with stimulus packages, everything went, and this was kind of inevitable. But I don't think anyone expected it to drop by this much over here. So I wouldn't even consider this, right? Option two is take assignment. Now, I don't see an issue with taking assignment. If you've done everything else that you believe is right, you've got your plan on, cost averaging down, uh, into this, assuming the fundamentals of PayPal have not changed, you could just take assignment, right? Or the third option is what you can do is roll the option. And what rolling an option means is that you buy to close the option. So you buy to close it, obviously at a loss, but then you immediately sell to open a new put option, hopefully at a higher price than what you closed it, so you get a net credit for the trade. And the kind of terminology of rolling an option is there are two things, in my opinion, what you should do here. If you're gonna roll, the first point is you want to roll down your option, which basically means you lower your strike. So from 75 to 70, for example. Probably if you're doing monthlies, you can only probably go down to 70, right? You roll down to 70, and then you roll out in expiration for another month, right? So you're rolling down your strike, and you roll out, as in you increase your expiration, whether it's 1 month or 2 months, whatever you decide to do, um, to hopefully receive a net credit. A net credit should be the main goal, i.e., you make money, right? Or in this case, it really should be break even or debit, right? So the order, if I was to do this, I would do it for either a net credit or to break even. So the cost of buying it back and the premium you get for selling to open a new one is zero. So it costs you $500 to buy it back, and then you sell to open the $70 strike at 500. Therefore, there's no cost to you, but you have lowered your strike by $5. What's that? About 8%. You've lowered again 8%, and you've taken $500 collateral out of this trade to get a lower strike, right? Or worst case, if you have to pay $60, for example, to go lower it to the 70 strike, you already got $121 in premium for selling the put originally. Therefore, if you're happy to give back $60 and only take $60 profit on that trade. So again, you can use this premium here to pay a debit on there. I personally, if you've done everything correctly, you shouldn't be in that place. I would personally take assignment unless it's really close. It's like at 74 and the premiums are quite high. So then you can make another 121, $200 or whatever it may be for it. So that's my option. If you're going to roll, you need to go down and you need to go out. I would only go out right? I would only go out, which basically means same strike, you're rolling out the expiration date. I would only do this for a net credit or break even. I would not pay a debit to keep the same strike. I would probably just take assignment, right? And then start my cost averaging in and then selling covered calls. So again, I think I'll probably do a separate video on rolling options because it is a bit of an art. Most platforms allow you to do it all in one go, so you don't need to create two trades of closing your option, selling a new one. You can do both legs, as it's called, together, execute the trade, and they both will happen together. So unless both aren't triggered, it won't trigger the trade. So that's how you manage it. Again, if you've done everything right, you should be happy to take assignment, right, of there. And then lastly, post trade. The first thing you do is you start tracking your cost basis and break even on a spreadsheet. And what I've done is, you can find this in the description. I have created this very basic spreadsheet for you to start doing this. You need to do this, right? There's so many people that do not track once they're assigned on what their cost basis is and what their break even is. Most brokers kind of show this stuff, but I think visually, I think you just need to understand it. On the chart. So what you need to do is you need to put your ticker symbol inside here, and it will calculate the price. So if we did PYPL, for example, you can see it then updates the kind of price. But I'm going to use Riot as an example, right? So this is my number of shares I own in Riot Blockchain, which is a Bitcoin mining company. The current price is 10.94. My break-even price on my cost basis is 25.88, and the current price is 10.94. So I'm 60% away from my current price. Not great. Again, we can talk about that at another time, right? So what we have here, what you have to fill in, you have to fill in these shaded areas, right? So once you put the ticker symbol in, you put the date assigned, and to be honest, I got a bit lazy putting that in there, but I strongly recommend doing it. Put the shares in that you own, and at the strike price, and then what it does, it calculates your total amount you have invested. So I've got 20,700 invested in this. And then what you need to do, and this should really be shaded, is you need to then look at your broker, look at your statements, and calculate the total number of premiums through selling puts, selling covered calls, include your covered call income on this as well, everything on here. And you can see I made 12.6k, I've invested 20, so I've made 61%, because Riot is a very aggressive, volatile stock. You can get some juicy premiums even if you're like 15% away from the current price. So my cost basis is 25.88. So the reason why we have this premium inside here, which will help you for the next section I'm going to talk about, is then it calculates your break-even price over here. So you can see here my break-even is 10.07, and it calculates this all for you based on the premium that you've gained. And therefore you can actually see here that we are actually above the break-even price, which is good to see, right? So that is what this calculator does, and these numbers are important for you to track. So again, link is inside the description for this. So the first thing you do is track. The next thing you do, you start selling covered calls to bring down your break even, because the additional premium you're going to receive is all going to be added to this section over here, which impacts your break even number. Now, in terms of the strike price for selling covered calls, right? Depending on where you got assigned, right? These are the preferences above your cost basis. So let's just say in the example we had is we sold, I think it was we sold the 75 strike. If you get assigned at 74, right, I would be selling at 75 or above. Now, if you want to keep the stock and you want to ride it back up, I would then sell it a lot higher than that, 76, 77, 80 or whatever, right? So I'm assuming here that you either want to do the wheel and get out of this and replenish your money, but again, adjust it if you want to keep the stock. Then obviously put it a lot higher than the current price, so then you don't get assigned that easily. The next thing is you sell it at your cost basis, right? So let's say you got assigned at 70, for example. If the closer you are to the current price, the higher premium you get. So that's why you want to know what your cost basis is. The next bit is, let's say you got assigned at, I don't know, 68, right? And if we go back to here, you got the 75 strike, and then you obviously made $1.21, so that's like 73.80ish or whatever it is. So your actual break even is around 73.80, right? So what you can do there is you start selling covered calls at your break even price, which is why as you sell more covered calls and as you sell more puts and all these things, your premium will get more higher, which will lower down your break even, right? So if we actually go back to my cost basis is 22.17. I've made 11k of premium, therefore my break even price is 22.95, right? So those are the three scenarios there. The next one here is, and this is what I've been doing on Riot. Well, I've been selling above my break even on Riot, but so that's not there. And I've been doing this on ChargePoint because it's so low down. Is doing my strike prices below my break even. So if we go back to ChargePoint, right, my break even is 22, the current price is around 13. I'm selling 17, 16, 15 covered calls. Now, this is advanced. I don't advise it for people because there is a chance you might get early assigned. I've never been early assigned on a covered call where I'm above the current price, right? I have been early assigned put options where I'm in the money effectively. So I've always been out the money pretty much on ChargePoint because I'm selling covered calls at about 10-15% above the current price on weeklies, right? And because I've got a lot of contracts, I've got 2,700 shares. That's 27 contracts. If I make 5 cents per contract, so that's $5 times by 27. That's still $135 a week. That's 500 times by 12. That's still 6.4k a year while I wait for ChargePoint to recover, right? So this is advanced. I don't recommend it, but I believe if you followed all the steps beforehand, hopefully you still got put options to put in place to lower down that cost basis, so you don't really need to be dependent on covered call income. You should be able to at least do it at your break-even number, right? So we do that. And then the next thing is then start selling your sell your next put, which is so then depending on what you got assigned on, and let's just say the stock price dropped to 59, right? Then you would need to adjust this slightly because you wouldn't be selling in the money puts at 60. Yeah, you get some decent premium, but then I would then probably look to sell the 51 and then drop this down to 30 or something. So this will need to adjust depending on where you got assigned, but then you'll be selling your next 100 share, your next put contract, to then pick up more premium to lower your break even, but more importantly to bring down your cost basis. So now you know what to do. You have a game plan going forward for if things start going wrong. If you start getting this scenario here, my view is not to panic. If you've done your fair value, if you know how much total you want to invest and what price points you want to do it, then you will be in a much better position than my charge point position. So I really hope you found value. Again, I still trade the wheel strategy, very, very profitable from a realized gains perspective. Yes, I'm holding a realized loss on the stock and things like that, but again, it's just like buying a house, right? If I buy a house and then the housing market crashes, right, I'm not going to sell my house. The asset is still there. It's still bringing me cash flow through rent. So I'm still making covered call income on the asset of ChargePoint shares that I'm holding. If I didn't believe in ChargePoint, I would sell ChargePoint. I sold work. The same situation happened to me on Workhorse. I sold Workhorse because I don't believe in Workhorse. I shouldn't have been in that stock in the first place. I've got a video on that as well. That's on the screen now if you want to look at that piece on why I sold my Workhorse shares, also the wheel strategy, and I'll see you guys in the next video.